Hi, it's Michael Farr from Farr, Miller and Washington. There's a lot going on in markets today, both in terms of news and market activity. Yesterday, we saw China come out and release that they were having lower orders for iron ore. That sent markets lower because people were concerned that the development rate in China might be slowing, and a lot of the world, and particularly U.S. markets, have been looking to China's growth to drive their share prices and to help drive their economies. If China starts to slow down, that could be a problem, at least in terms of more modest growth in other places, including for some U.S. companies. Today's economic data showed that housing sales were down and housing prices were about flat. So we were expecting to see better than expected housing numbers. Didn't happen. In the past couple of weeks, we've also seen interest rates start to rise. They had a low at the beginning of the year around 1.85%. They got up to 2.38%. That's a pretty big jump in a 10-year Treasury. It's about 5 or 6 actual full points per bond difference. So people who bought a 1.75% bond and have seen that price decline if they had to sell today, they would sell at a loss. Should rates go to 4% on the 10-year Treasury, the price of the 10-year Treasury will fall to about $86 or $87 per from 100. So a significant decline in prices for those who are looking for safety. We're not sure yet, of course, if this is a real reversal in bond prices and in interest rates, if this is going to be the beginning of a surge higher. I talked with Kathleen Hayes at Bloomberg. She's an old bond pro and a great friend. Kathleen suggests that if Europe gets solved easily and benignly, then yes, we've probably seen the low in bond yields and the high in bond prices. Remember, they go opposite of each other. If, on the other hand, Europe begins to become problematic, then we could see additional Fed intervention and we could see bonds rally again and those yields go lower. If that happened, and the Fed whispered of greater intervention, maybe QE3, you'd also see the price of gold spike back up. So interest rates are reminding us that there is still great volatility in bond prices. Our writing this week warned folks that perhaps you should pay close attention, particularly to your bond funds. Bond funds own a whole lot of different maturities, and if individuals become concerned and they start to place sell orders for those bonds, bond portfolio managers in down markets have to go liquidate those bonds. They're selling into a weak market, and those fund share prices really can fall quite dramatically in a rising rate environment. So be careful and know that you're more defensive if your maturities are shorter and your coupons are a little bit higher. The interest rate, stated interest rate on your bonds are a little bit higher. Technology stocks have been doing very well. With the higher interest rates, we've also seen bank stocks do very well. Apple's instated a dividend, and the rumor today is Google will not be far behind. Google stock very strong today, Apple inching along. So that's of great interest to us. That's one of our companies we own in our portfolios. So we've seen a great year so far, up 11 or 12% since January. We're up some 25 or 26% since September 30th, 2011. If the old rule is to buy low and sell high, after you've seen a 26% rally in 4 or 5 months, that doesn't strike me as low. So I would be patient and keep my powder dry, look for really good values, and buy companies with really strong balance sheets, organic earnings growth, good management so that they're managing the top line as well as the bottom line, and make sure you give them enough time to work out for you. Thanks for listening today. For Farr, Miller in Washington, I'm Michael Farr.